Welcome, everybody. Wonderful to see all of our savvy investors yet again. It is that time to have another YouTube live on a wonderful topic on a beautiful sunny day here in Vancouver. Finally, we've been getting so much rain. It's been crazy. So for those that don't know me, I am Mike Ponte. I'm the founder of Savvy Investor and longtime Canadian real estate investor. And again, welcome to our Savvy Investor YouTube channel. Just great to have everybody here. And again, we are having regular topics, new topics, guest speakers, talking about all the wonderful things that we love, real estate investing. So as you're jumping on, say hello to us in the comments. We always love to see everybody's smiling faces, to get those keyboards working. Let us know who you are and where you're calling from. It's just always great to see everybody jumping on here live. So tonight's session is actually a real great one, specifically for those that are noticing, I don't know, is there changes in the real estate marketplace? I don't know if anybody's noticed inflationary costs are going up. Interest rates. I don't know if anybody's seen interest rates go up, or utility costs, insurance costs. There's all sorts of crazy things that are going on. And not to mention government intervention impacting our business as well. That's impacting a lot of our costs in our business. And so for many of us investors, they're probably seeing or noticing that there is impact in our overall cash flow strategy, especially in markets that are not used to this. And this is bizarre for a lot of us that are maybe in Vancouver and Toronto. They're just like, wait a minute, this is unusual. What's going on? Prices are actually going down. Well, that's not necessarily working with my initial investment strategy, because I'm trying to leave my job. I'm trying to focus on something else. I want to be generating more income, but it's not working. So maybe my market is not the right market anymore, even though it's been the right market for the last 6 to 10 years. Oh my goodness. So it is really, really important not to throw your hands up in the air, give up. It just may be a situation where you just may need to pivot a little bit. And that is really kind of the topic today. But where do you start? How do you begin? How do you manage this whole pivoting approach to this? But where you do need to start is something that is extremely important. And it is the terminology that is very widely used is due diligence, and how to research a new market, how to start with that whole process. Many of us investors have heard the terminology due diligence and market research, and do this before you start investing. And you hear this on webinars and social media, and you see this on big real estate investing events, but they just don't get into the kind of the meat and potatoes of what this really is, and understanding how to conduct this. So if this sounds like that you don't know, not to worry, you are absolutely not alone, which is why I brought out the big guns out today, the real big guns, to share on this really, really important topic and to help us savvy investors to become extra savvy. So I'm extremely, extremely fortunate to have a longtime international investor, educator, analyst, Jennifer Hunt, joining me today to share some of her amazing wisdom. And trust me, lots of wisdom here. Jennifer Hunt's actually a veteran, and when it comes to real estate investing, with over 20 years of real estate investing experience. 20 years. She must have started when she was 10 years old. Must have, right? But she's also a manager. She's a real estate developer, construction of multiple real estate investing projects. Definitely highly recognized in the investing community, and has also been a vice president of research of a very large real estate education group as well. And she is now the chief intelligence officer of her own company, Real Estate Wealth Lab, which I'm sure many of you guys have seen. And this is really what she does, and what her company does is really provides research on this very important topic for us real estate investors when it comes to due diligence, which is the topic of today. In addition to that, she's done amazing things. She's also a serial entrepreneur as well. And definitely and it was an executive with over 10 different companies. So it's a wealth of business knowledge to boot. And again, this really highlights to the topic of today, which is the due diligence side, not just for real estate investors, but also for businesses alike. Because a lot of companies are looking at what's going on out there and how this is going to impact their business. So very, very honored to have her join us today. And she's a very, very busy person, especially where she's calling from. She's actually living in Hawaii, of all places. Talk about being jealous. definitely being jealous. We should all be jealous, right? So before we get started, just a friendly reminder, please share your comments, questions. This is a very interactive, as you guys all know, I love when things get interactive. So again, please share your comments, questions, even for those that are watching the recording, post them. We can always get those questions answered at a later time. To help you guys make sure you get your fingers warmed up a little bit, do us a little bit of a favor. Subscribe to our YouTube channel if you have not already. Again, just hit that notification button. Give us a like. It helps us with the algorithms as we support the growth of our channel as well. So with that being said, let's get to the topic at hand and invite our wonderful speaker, Jennifer. So Jennifer, welcome to Savvy Investors YouTube channel. Really appreciate you joining us today. First of all, how have you been? Silly question, really, because you are based in Hawaii. So how bad can it really be, right? So
awesome. Well, thank you so much, Michael, for having me and for reaching out and continuing our relationship and our business ventures and whatnot. Always great to connect with you and your savvy investors. And yeah, thank you for the wonderful introduction. So I am indeed a real estate researcher and market analyst. And I think what's really important, and thanks for touching on that, is I'm actually a real estate investor on both sides of the border and have been for over, I won't say how long, about 12 years in both the US and Canada, and even longer in the corporate world. So I practice what I preach, and I think that that's really important out there.
Agreed.
So,
Agreed.
yeah.
Agreed. Yeah, good. So tell me, whereabouts are you investing these days?
Well, I love that question, because in your intro, you're even like, well, do you need to pivot? And quite frankly, I pivoted. I sold a significant portion of my portfolio while it was up in Ontario, and am redeploying that capital to other markets. And one of the key things I think is really useful right now is actual diversification. So when we're looking at markets, I'm looking at global markets. I'm looking at US, Canada, and comparing those markets with even further Costa Rica, Portugal, Nicaragua, you name it, because it's one thing to be looking in just Canada. And yes, I analyze those markets too. But what about diversifying and political differences, currency? So you can hedge against a whole bunch of different things. And I believe in knowing your markets incredibly well. So yes, doing due diligence, but having multiple markets as hedges and risk mitigation strategies.
Totally agree with you. And it's funny you said that, because I'm doing exactly the same thing. As I was sharing with Jennifer before we jumped on, I'm heading out to Portugal actually for 3 weeks in August. And of course, I'm going to be poking my head around there being a real estate investor. Don't tell CRA, but I'm going to try to make this a business trip too. But the reality is, it's a good opportunity to explore some different markets. It's sometimes the backyard just doesn't make sense. And it comes right to the point. It's and get right into this. It's like, we are definitely living in very interesting times, and markets that have done well for a while and for a very long time are now being challenged. And so all of a sudden there's a kink in the armor that has been solidified. It's been really interesting, to say it lightly, for markets. Us in Vancouver, we're just like, what do you mean? Prices just go up 15 to 20%. That's just normal. That's just what it is. I've heard many investors say, I invest in only appreciating markets, not realizing there is actually something called a real estate cycle, which is bizarre, right? But it's just not have done that version of the cycle. It's just been the rounding part. So maybe.
Well, actually, and Michael, Vancouver has done this, in fact. And in 2018, it actually had a cycle, but it lasted 6 months, where it went into. So it's about also forecasting with more accuracy the duration of that cycle, because that's the key part. It's still doing this. This is my version of the cycle with some reverberation in it in markets. Right. But now we need to, and we can with the Real Estate Wealth Lab, is actually find that duration. How long is it going to be, going through a contraction for? So
right, great. So let me ask you, and I kind of shared this at the very beginning. A lot of people have heard this, and I know you and I talked about this before. It's just like a lot of people have heard due diligence. It's talked about. Nobody knows what the heck it is. So maybe again, let's take it to the most simplest. If I was a 5-year-old and you were talking to me, what is real estate market due diligence? And I guess the second part to that question is why is it important for us real estate investors to be paying attention to this?
Okay, well, maybe I'll start with a story
Sure.
then. When I first started real estate investing, I mean, as in buying a property for rental, I had my own home and I was sort of, stumbling into it. But I remember my very first like true real estate investment property, I bought it because it was cheap.
Mhm.
Makes
For sure.
sense. Buy for cheap, get renters in there, and that's going to be a good return on investment. Well, it wasn't. I didn't know anything about market diligence and I didn't know anything about real estate cycles. And yes, this is a long time ago. And so I bought in the wrong place, in the wrong neighborhood, in the wrong, you name it, at the wrong time. And thankfully it was inexpensive. So it was a nice, relatively inexpensive lesson. But I had to hold that for a long time and do all the right things to try and value add and then extract myself from it. So diligence is making sure that you don't repeat the mistake that I made ultimately. So don't buy for cheap. So we look, and what we want to be doing is looking at economic and political and all these other kinds of indicators. We're going to call them indicators. And I'll get into some of the layers of those in a moment. And looking at those indicators to get a sense of where the market, first of all, if it's a good market, and second of all, where it is in its real estate cycle. So are you buying, selling, holding, avoiding a particular market? And you want to actually, I know this is crazy because again, when I first started, I just wanted to be buying real estate. Get out there, buy a piece of property.
Exactly. Yeah.
And then wait, all of a sudden Jennifer Hunt comes on and starts talking about macroeconomics and global GDP and printing money and inflation. And these kinds of things truly are so important to your real estate business. And I love how you mentioned that earlier, Michael, in your introduction of even just business, like all businesses need to be really aware of that. And so as a result, this is where we are in terms of looking at hundreds of indicators. When we look at actually assessing I know that's like next layer of due diligence, but when you want to compare, countries, then provinces or states, then cities, and then neighborhoods, there's actually over 100 indicators that one needs to look at, rank, score, and weight separately. And then when we look at the real estate cycle, and I've just come up with the real estate cycle formula, which actually looks at over 32 indicators and weights them and scores them because they act as different levers at different times. So a couple of examples of that. So what you want to for sure, like this is back to here, if your absolute minimum, so you want to be looking at leading indicators like the economy, yes, and macro. So GDP, economic activity, jobs, diversity of multiple industries, ideally. You also want to be looking at jobs, unemployment, participation rate, labor force. I mean, you name it, it gets pretty detailed, and also population growth. And those three are typically the most rudimentary, if you will. However, the real estate cycle formula includes a lot more. And I will give you a little tip because it's not been copyrighted yet, but it includes inflation.
Yeah.
And that is important, especially in these times and how that impacts our real estate. So I hope that answers a little bit about that market diligence and not even starting with the property analysis. That comes way later. Pick your markets first and that are really open to business and will help you grow your portfolio in a really, I'm a very conservative investor. I like to make sure that, things are protected and that the markets are good and whatnot. And so that's what I like to provide for real estate investors.
For sure. And I think that lots of great nuggets right off the bat. And I'm sure we can go into this. Jennifer and I were talking about this before. We could talk for hours and hours about this stuff because it's just so, well, for us that are like the statistics and we're kind of geeking out a little bit, this stuff, it is really just a wealth of knowledge. But like Jennifer, I'm very conservative as well in my approach, my investments. And for me, this is crucial to do from my perspective versus before you invest. And for those that have got 100,000, 50, this is hard-earned money. This is a lot of money, guys. 100,000 bucks. That's a lot of cash. that, take the time to do some of that research before you do it. So here comes the question is, why do most investors not do due diligence? What's your feeling? Do you think that's the case? And because, for me, and I'll just share my own experience, is I see a lot of people following information, or I shouldn't say information. They are kind of keeping up with the Joneses, as I like to reference, is they see somebody doing something and they just kind of follow accordingly, but they really don't know if that actual person knows what they're doing, if you understand what I'm saying.
Yeah, I do.
So I always challenge that is, don't listen to where Mike Ponte is investing. Don't listen to where Jennifer is investing. Do your own assessment first, because how do you know we know what we're doing before you jump in? And so, that's the key is, why do you think most investors don't take the time to do due diligence? Jennifer, what do you think?
Well, to be honest, I wouldn't say that most investors don't take that time. I think that I'm in the circles that I'm in, I would say most do, or they at least know to ask questions and get information, at least a starting point, from individuals who do that and watch markets. However, I do believe that when first starting out, yes, like when you're first beginning, okay, you might not be doing that diligence, and that's about getting education for sure, and getting surrounded by individuals. Whether you agree or not, you're going to get information and sources. But I'm going to actually step back even further, because ultimately it matters about what you want your life to be like. This is about life by design. And so, for example, I'm focusing on Hawaii real estate. Well, that's not for everyone. And in fact, the model that I've developed is for vacation rentals and co-ownership, is actually something that I recommend if you're looking for massive return on investment. This isn't for you. Go somewhere else, find a different market, find a different product like industrial or storage or whatever have you, that you're going to have a higher return on investment. But if you're looking for some asset protection, some wealth building and lifestyle, and some tax implications and some fun, well, then this is a product for you. So it's a matter of, and then that's how you'll choose your market a little bit too. So there's a real layer of self-discovery in order to create the portfolio that doesn't own you, so that you own it and it's working for you. And then you can help choose your markets around that.
Love it. Love it. So I guess let's take a step back here a little bit based on some of the things that you've referenced in regards to key indicators that you've highlighted. You mentioned earlier 100, and you're like, oh my God, right? That's a lot. And then even 30, it's just like, oh my goodness, right? But I think it's, for a lot of investors, that this is a new thing. This whole, like, to your point, you might have a little bit of this 6 months, but you have other markets that have been 6 years, if not longer, right?
Yeah.
And so
Yes.
with that being said, there's individuals that have invested in markets that have been appreciating for 20
Decades.
years in a lot of cases, 20 years. And that is very, in some cases, very unusual to see such a huge swing of that level to a percentage level that we're seeing. But now all of a sudden they're pivoting, or they're thinking of pivoting, and they're just like, okay, I've been investing in this market for all these years. How do I go about it? And I think you highlighted this first. So starting off with the macro approach, and I'm assuming when you say macro approach, provincial, I guess, or even national, like maybe countries.
National,
and then,
for sure. Start with countries.
Yeah, and then working it down. So you say let's just go maybe provincial to start off with, or from a national perspective, right? And then you look at macro at a provincial perspective. And then you base it off some of the indicators you've referenced, and again, highlight population, job growth, labor. I'll let you kind of finish off.
I'll give you a little example. Recently, I was looking, again, this is back at super macro. Like, are you picking the US or Canada as a for instance? Okay, so I looked at, and now forgive me, I won't remember the exact name of the study, but it was hundreds of pages long, and it was international migration patterns. And you know that song Cotton Eye Joe, where'd you come from, where'd you go? Well, that's what you want to look for. So I went through this study and found, okay, so what are the net gainers? Who is attracting the most people? Where are they moving to? And where are they moving from? And identifying those types of patterns will help you identify a country, for example. And through that analysis and looking at these reports and other reports as well, the US is still the most attractive location for people to move to.
Interesting.
Okay. So now by percentage, because you'll often hear this, Canada's percentage of immigration is massive, but we're a tiny, tiny country by comparison to the US population. So when you actually look at our percentage, and I love this, like this is where I can get really geeky. When you're hearing about percentage increases and decreases, just be mindful. We always want to look at the net, like what's actually the numbers. So by percentage, for example, Canada has a massive, immigration target in the 400,000s a year, etc.
Right.
That's big. But in the US, it's a tiny percentage of immigration, but their numbers are millions, or at least a million in terms of immigration. And so then you can start extrapolating, and that's just one example. Then you go, okay, well, let's say where they're going into the US. So by the way, they're moving to Florida and the Sun Belt. That is the net gainers of population. And so then looking at similar trends in Canada, and there's lots of really fun ways of looking at it. So there's census data, just typically older and whatnot, but there's also fun reports to look at, like the U-Haul report. It's published every January, and it just shows where did the one-way trucks that were moving people go to and stick there. And that's really helpful. And actually Vancouver and British Columbia are right now remaining the top net population growth locations. And if I may, Michael, I see that Danny is asking in the chat, what's the minimum population while picking a market in a city? If I may just touch on that, because I love that question, Danny. And it's, again, because it sounds like Michael and I are both on the conservative, picking the right markets. And through my research and my experience, because I've gone into smaller cities and but great cap rates because there's more risk, I would say that, let me put it this way. If you're looking at a city that's under 50,000 people, the banks, the financial institutions, if you're going to try and get financing, they are less amenable to that. So you're going to have, at a minimum, different conversations with your financier, your broker, your banker, whoever it is that you're getting financing from in those smaller cities. So that's a good start. And then upwards of 75,000 is kind of where I would put my starting cap, just for me personally, because then I know that there's enough flex in that market. Now, that said, got to look at all the other factors and indicators that I mentioned, but I wanted to just address that. So 75,000.
Yeah. I'm with you there too, because I like substance to my markets as well. And I call one trick ponies being one industry, one market, one company in some cases, high risk, and trust me, it's kind of boom and bust. And we see a lot of that here in BC for sure. And I hate to pigeonhole a specific industries, but the lumber industry does do that. And we've got small markets that are very dependent on that. So just be aware of that. And the banks will be very clear with you in regards to stating if they're going to cooperate or not. So if the banks aren't, it's because they find that is risky, right? And that's the reason why, right? So
and to add to that, another early on story. I didn't know anything about real estate markets, but I was starting to get a sense of it now. And I was looking at multifamily apartment buildings, I think it was like a 25 unit, 30 unit apartment building in somewhere in British Columbia. And it's like, this is interesting. The cap rate's like 13 or 14%. I mean, I was very interested in this.
Let's do it.
But I did at least have some common sense and some critical thinking, so this is good. And when looking at that market, I realized what you said about like a one pony show. One trick pony, one trick pony. That's it. Thank you. And I started to read, in terms of economy, it's a mining town, and there was only one mine. So in terms of due diligence, which is our topic today, in that particular case, Michael, I actually called up the mine. How many years of reserves on your mine? 13 years. So what's going to happen to that apartment building in 13 years when there is nothing left? There's no other mines, and that mine has gone, like, it's extrapolated everything that it needs to. So that's where these kinds of layers can get sometimes kind of interesting.
Agreed. So let's, and thanks, Danny, for your question. And for those that are watching, please post your questions. We can see it and we'll make sure we try to do our best to get them answered. So to go back to kind of some of the fundamental aspects of this, and you highlighted some key criterias. And again, it's been really interesting with everything going on with the pandemic. And secondly, we talked about politics as well. That's impacting our business a little bit. Have you noticed, has some of the indicators changed a little bit, or the fundamentals changed a little bit compared to maybe what it was from the past? Because, even myself, this is a topic that I really is near and dear to my heart. And I've kind of seen, again, I'm not going to tell you to answer my question. I'll let you answer my question, but it's been really interesting to see the last few years. So I'll ask the question again. Have you seen any of the key indicators be added or changed over the last maybe 4 or 5 years that maybe people should be aware of, that is something that is important to be watching out for? So
100%. And that's, I woke up in the middle of the night. It was actually about a year and 1 month ago, 13 months ago, with the real estate cycle formula in my head, because we needed more data, and it needed to be more pertinent to what is currently going on since the government restrictions imposed upon in order to respond to the COVID-19 pandemic. And watching those unfold and starting to see and knowing some basic economics 101, I will say, and I am going to have to go there. So economics 101, when you print a lot of money, when the government, prints a lot of money, this is about inflation, ladies and gentlemen. So when the government prints a lot of money and the economic output isn't really there, which we had in 2020, we can expect inflation. That's basically it. That there's no supply chain issues. There are, but that's not an impact of inflation. Inflation is only caused by a government printing money when the economic output isn't satisfactory. So for example, in 2008, with that financial crisis, of course, Canada was differently positioned than the US in terms of its the robustness of its banks and its mortgage lending qualities at that time. But the government still printed a ton of money for quantitative easing, but they left it on the balance sheets. They didn't put it into the hands of consumers. They didn't put it into what's called M2 money supply. So it didn't create this velocity. What happened is it got, this time with the COVID restrictions and the government responses, that they printed the money and then they put it into the supply, into the consumer supply. Consumers sat on it, but it was still out there, and now it's starting to circulate. And what happens is whenever that moment, like the printing press starts and it gets out there in the world, a little for you, a little for, so-and-so, that is the trigger for inflation 18 months later, because it's a lagging indicator, but it's also a leading indicator when it comes to interest rates. So now we know inflation is coming, and then we know interest rates are also coming. And I know this is probably, I hope this isn't too deep, but I think it's really important for individuals to recognize that when you see headlines out there of, it's the Ukraine and Russia situation, no, like this is all predictable. And inflation for real estate means that our interest rates are going to go up. But it also means that typically real estate outperforms, or at least it holds its value in line with inflation. So inflation's going up, let's say it's at 8%, it's not, it's higher. So come and check out more on that, because I'll be talking more about it soon. But as it goes up, real estate at least holds its value with inflation, whereas stocks typically will drop in inflationary times. Okay, so that's a bonus for real estate. That's good, but it's kind of a net thing, because inflation's going up and your real estate's going up. But behind the scenes, you're actually benefiting from it's basically the delta, if you will. You get further return on investment by having a mortgage and paying that mortgage off with inflated dollars. So it's a pretty interesting model, and I'm going to be actually modeling it out so that individuals can see just how powerful real estate investing is during inflationary times. And these types of things, back into your question about, well, what should we be looking at, is absolutely that. And then also political climate. I've always looked at political climate, But now we need to be looking at it and scoring it and
Oh,
ranking
yeah.
it based on other factors. So, for example, in the US, there's like their constitution really, like, it actually talks about property rights. You know, it is a solid core value of the United States. And in Canada, it's there, but it's not as overt. It's not as I guess powerful. And how I can provide evidence of that is that through some of the responses, the government responses to the pandemic, they implemented. So like Saskatchewan implemented it, Alberta, British Columbia even, and then of course most recently at the national level with the trucker convoy at the national level, the Emergencies Act. And the Emergencies Act in all of those cases has very specific language about appropriation of property rights. So these are things that, not to be like scared, but we need to be aware of. And there's certain language, and I have that language, by the way, legally from a lawyer, that if someone is trying to, assert in terms of their property rights over you, there are certain words that you can say. It's in one of my presentations from last fall. Cool. So those things have all made it in. Who knew? Who knew? Interesting times.
Yeah. So let me ask you, like with some of the stuff in the pandemic, and again, very interesting things have happened, is okay, we were shut down. We're working from home in a virtual world. We're still even meeting like this in a virtual world, right?
Yeah.
So people are now working from home, and there's been more flexibility for people no longer needing to be close to their work environment anymore. And so
yeah.
I guess my question that I ask is, has affordability, with everything going on with inflation, with everything going on with interest rates, do we, maybe based on your research and things that you're finding, are you seeing, almost to Danny's point, maybe population is still an important part, but do you see people migrating based on affordability? And is that a trend that maybe is going to be coming a little bit more closer now that there's maybe a little bit more flexibility in the working environment? So
I love this question, and I could probably talk for an hour just on it, but I'll give you a Cole's notes. So
sure.
That trend was actually already in process, and the GTAs and Vancouver was already a very good example of it. We saw individuals moving out to, in Vancouver, for example, all the way out to Abbotsford and Chilliwack, for that affordability, among other reasons, of course. But that was happening prior to the government restrictions for the pandemic. So those restrictions and the work from home culture certainly exacerbated and accelerated a pre-existing trend. There was also a trend of moving into multi-generational housing.
Right.
And so guess what? Having a bigger house out further, pandemic restrictions, this is perfect. So that, again, accelerated that. Meanwhile, for those of you who were following me, you would have heard that in September 2021, approximately, what was happening is that by people moving out of the urban cores, what's starting to show up is that condos downtown urban centers, downtown Toronto, downtown Vancouver, there was a softening in the condo market.
Right.
A fantastic time to buy. And millennials who could see that and their affordability, and I mean, less concern about the potential impacts of it, was an opportunity. Let's put it that way. Okay. And so right at about that time, individuals started, millennials primarily, and Gen Zs, and what I call, I have so much information here, but anyway, so older Gen Zs and younger millennials, I've called them the Millenzies, because they're operating more as like a buying cohort that we need to be, as real estate investors or rental housing providers, need to be aware of. And so the Millenzies went, hey, I want back into downtown cores. So rents went up and people started buying in those downtown cores. So I think we're going to see a balance, especially a balance of those sort of rural markets, or I call them, like, you've maybe heard of exurbs. So it's like suburbs, and then just outside of those, there's still going to be very, very the high demand for those areas. But we're not going to lose sight of the downtown cores, primarily in the big cities where we have immigration. So the key cities for immigration are Toronto and Vancouver, Montreal, and then also Calgary and Edmonton. Those they are. So those are going to be, they're going to be just fine over the long run. And we're going to see that demand come out. And then one more point on that is back to the millennials. Now we're getting the Gen Zs. They're like, there's a big cohort, and they're actually going to overtake the baby boomer cohort. And so as they enter the market, and we've got millennials who are a big cohort, and now these Gen Zs, there's going to be quite a bit of first-time home buyer demand. Well, guess what they can afford? Condos. So right. The demand will still be there for those condos, despite the fear that really surrounded them at first. So
very interesting. So I guess with all these changes, I guess, we talked about pivot, right? That's the thing is sometimes the market may shift, but it could be even just pivoting in a different type of property segment in some cases is to maybe we talk about is like, okay, you see people leaving maybe the Vancouver marketplace to go live out in the suburbs because they want to buy a house, but then there's inventory in the condo market that's become more affordable, and now the younger generation now has the ability to acquire it because the demand's come down. So the pivoting could happen in a couple different ways. Is just in the property segment, I still believe that there will probably be migration changes as well, population wise, based on affordability too. But
100%,
right? But it's interesting to hear that from you, from some of the different property segments that may do quite well, even during these times of higher inflation and higher costs, or maybe they can't buy a townhome, but then maybe they're buying a condo instead, right? So.
Right. And then they're still thinking ahead to the lifestyle that they want in the future. And so they had a little moment of affordability. It's different. It's not affordability like moving out to, wherever in a further suburb or whatever have you, but there was a window. And speaking of windows, I do expect, and this is again based on just the real estate cycle formula, when GDP drops, property rents drop about a year later. Again, this is ceteris paribus. These durations can be affected, but typically, so GDP drops or population drops big time, or jobs or whatever, some combination of those, they drop, and then you get rents will come down about a year later, and then property prices will come down about 2 years later. Now, for all of the reasons that it sort of materialized like that, but it sort of didn't. And one of the reasons is because most individuals just look at GDP and jobs.
Right.
But population is actually that's why I love that question earlier. Population growth is such an incredible, it's got to be weighted more. Because, so for example, people were moving to Florida, the Great Refuge, they were quite open. They didn't close down businesses. And so people moved there without the jobs or the economic activity, but they create it. So if you get where the people are going, they are bringing innovation, they're bringing jobs, they're going to create that economic activity. And so it's almost more important than having the economic activity to begin with. Right. And so as we watch those kinds of indicators and how they play out, like that's where, so for example, like with Toronto, the downtown core kind of went down, but guess what? It was in 2020. Here's where it gets really interesting. Everyone was wondering, why was the market so hot in 2020 and 2021? How's this? So it was responding to the GDP from 2 years prior, because it's a 2-year lag time. So GDP was friggin' great 2 years prior. But also the population, the immigration targets were at its highest in Canada in 2017, 2018, and 2019. So 2017 population, typically immigrants come to Canada. This is specifically for Canada. Typically about 77% of immigrants to Canada come with a down payment. And they take 3 years of renting and figuring out where they want to live, and then they buy. So that's, 300,000 of the 400,000, let's call it approximately, whatever, that they were buying in 2020 from 2017 immigration. Same thing for 2021. It was a 2018 immigration, and 2019 was the highest level of immigration Canada's ever seen, which has actually buoyed our real estate market a little bit, even though based on GDP, it should be softening right about now. It's all actually pretty much on schedule when you're looking at due diligence, as you say. And so, so we do see a softening this year because of these other factors like economically and inflation and whatnot. But we see a softening this year and a softening in 2023 through 2024. However, I'm still considering that it's, as long as you've got a proper cash flow property and you can support it, and you're not support it, it supports itself, pardon me, and you've got the mindset that it's a great time to buy real estate and to hold on to it for at least a decade, because we're seeing the fundamentals underneath as a long-term, they're good. Like, add in, I haven't talked about it, the lack of supply. And if you add in that lack of supply and all these other indicators and weight them effectively, there's a long, modest expansionary period ahead for real estate, about a decade. And at minimum, then you're going to, ride the inflationary wave.
Right.
So, but you do need to be mindful that it will, and by the way, all the big disclaimers here, this is not advice. So this is just market analysis, and do with it as you need to. But certainly we will see a softening, and that's where the fear comes in. And confidence in the market is actually another indicator, because that's going to, those emotions do come into play. And so when you talk about diligence, well, what is the confidence? Confidence is dropping. Okay, what's that going to mean? Property prices are actually probably going to come down because confidence is coming down. But once people can get beyond that and see the bigger vision and the longer vision and have the mindset for it, and know that the headlines are going to feel very scary for the next 3 years at minimum, there's some real opportunities.
Perfect. Really great stuff. And like I said, there's just so much to unpack out of this. It's a lot, guys. And so I hope you're listening to this and it's not like confusing, but at the end of the day, this is a lot of information, but very, very key. And so let me get into another question here, Jennifer. Obviously, you've got lots of knowledge, lots of experience. And so for some of us that are watching today, they're just like, okay, I don't even know where to begin, because you know what I read is the National Post, the Globe and Mail, a few other different things. What are, for people that are just trying to get their head wrapped around on this, what are resources, what are places, what are some good places to maybe begin with? Like, just say, for example, population growth or GDP growth. Is there like good resources just to tap into that you would suggest, just to kind of get people thinking
Michael,
about it, right?
That is $1 million question.
Yeah.
I have been looking at all kinds of different cool ways of finding data and automating it, and I'm thankful that at the Real Estate Wealth Lab, our chief technology officer is working with me on this. And but there is no good answer. I am curating a source book, if you will. So that, and it's for US and Canada, and I'm starting it nationally and then bringing it down for all of the indicators. So, because it is not an easy thing to do. And you've got to look at different data for different things. And the most important thing, is never look at one source. So you want to have some basic sources that you can go to and kind of like see what that trend is. But what is very important, and I've seen this for years now that I've been doing this, almost 10 years, or even longer actually, in terms of market analysis, is getting other sources from different, like completely different. Because here's a good example. So the market consensus for the chief economists for financial institutions in Canada in January, so this is market consensus. So basically all the chief economists most at the financial institutions, the big names, they all said the same thing about inflation in January. Do you want to know what that was?
Let's hear it. All
right. That inflation would disappear by the end of 2022. Wow. Disappear. So that was a headline across Canada by our chief economists. Okay. I don't know what the bias was. I don't know what was going through their heads. I have some of you on speed dial. I love you, but I still don't understand why that would be the market consensus when Economics 101 was clearly stating and showing that inflation hasn't even started. It is around for a long time. So be prepared for it. So this is why you want to not just have one source. So the short answer is, I think just come out and hang out with me at the Real Estate Wealth Lab, if I may say so, or just get on our mailing list and start paying attention there, because it can be quite confusing and you want to be able to find out their biases.
Yeah, and it's a tough one to go through, but I think the more involved us investors get in this. Get your head wrapped around this. It's actually quite fascinating to begin with, number one. But you're taking a lot of the risk out of it too in your business. And I think that's really, really key, especially when you're just getting started. And again, like I said, sometimes people just invest based on what other people are doing, but don't make the assumption they actually know what they're doing. Do your own assessment first and take the time to learn this or get yourself surrounded by this. And
Yeah.
you know what? There's, again, I agree with you, Jennifer. Like even myself, when I do it, it's just multiple sources, listen to difference of opinions, and try to make the best reasonable judgment that I possibly can if I'm pivoting in a different market or whatever the case may be. So
Yeah.
um,
And on that note, whenever you're looking at a market analysis, make sure, and this is something I pride myself on as well, it's just I always have the source so that at least you can go, and so if you're seeing a market analysis out there by anybody, it doesn't matter whom, just make sure that there's like a little source. It doesn't have to be the exact web page or whatever have you, but like knowing that there's some credibility behind it so that you can go and fact check for yourself. And that's a great place to start in terms of finding sources.
Love it. Love it. Great. Okay. So there's a lot of people that are joining this, are going to be watching the recording, and they're here purposely for one thing is they want to see the Jennifer Hunt crystal ball. And again, put a big caveat and some disclaimers. This is not a reference in regards to where, but again, because it can be difficult. But I think the important part is, what's your feeling for 2022, 2023, specifically when it comes to the markets? And I'm talking real estate markets. What's your feeling? Is there some markets that are going to do better than others? Kind of maybe give us kind of a sense of your guys' thoughts for 2022 and 2023. And again, we're not going to hold you to it because we're always going to take our time to do our research first. But what are you feeling, or what's your thoughts?
A bunch of different things, but I'm going to start with thank you for the disclaimer. And secondarily, forecasts are meant to be reforecasted because new information. And one of your questions actually in the email that you sent me was, well, can these change and can these forecasts change? They can change tomorrow. Right. And so it's a matter of being on top of it all the time. And this is why I produce a weekly newsletter, because one government policy can completely change an economy, an industry, a sector, your real estate, your rental controls. I mean, you name it, they can really affect it. So the answer is yes, this could change at any time. At the moment, ceteris paribus, all things being equal, it appears as though for the 2022, it will, and I mentioned this a little bit earlier, but I'll recap it. 2022, we'll see a softening. Remember, the headlines are going to be sounding like it dropped 20%. But remember, in many markets, we've had like 10%, 20%, 30% increases year over year. So are they going to fall pre-pandemic? Are they going to fall like too far? It's about that net. So always be measuring the net difference between what they're saying it's falling and what it's, accumulated in terms of appreciation over the last few years. But yes, we are going to see a softening, which means that there's still going to be growth. 2023, 2024, same thing, softening, but softened growth. Now, the big wild card there is what happens politically, what happens with inflation, because with inflation, the only cures are higher interest rates and the government stopping to print money. So if those two things happen, and by the way, a little tip here, a lot of people are asking, well, how much are interest rates going to go up? You want to know?
I do. Right. I want to know.
Okay, so interest rates, by Economics 101 theory, thank you, Milton Friedman, they have to go up the same amount or higher than inflation. So let's assume that inflation rate is 8%, which is higher. Then interest rates would theoretically need to be 9% or 10% above inflation in order to even make a dent. Now, Canadian economy, because it's based on GDP, like 20% of it is is real estate is a part of its GDP. There's not a lot of wiggle room for those kinds of high interest rates. So it's going to be a really interesting discovery to watch how this plays out. And so then back to your question about, okay, 2023, 2024 softening, what the next question is how long will, and by the way, with interest rates comes a recession. So there will be a recession, but it's how deep and how long will that recession be? And then how you've positioned your portfolio, because there's some really cool benefits to ride that inflationary wave up as well. So,
Right.
and then again, I'm speaking really broadly here at the macro level, but I like right down to the state and provincial level, and then right down to your city and your neighborhood, because there is not a Canadian market. So I am speaking very broadly, and you know this, Michael, of course. You want to get right down into that city and even into a neighborhood, because one area of a neighborhood is going to outperform another. But the cool thing is, once you understand the due diligence and the indicators and how they interact with one another, you can actually do this on a napkin. It really doesn't take long. It's GDP improving, it's the population growing. Okay, so in 2 years things will be probably pretty good.
Yep. Agreed. And you nailed it right on the head from my perspective. It's just like, there's going to be markets that are going to be a little bit more challenged than others. And there's going to be, and again, if you just read the headlines, it just references Canadian real estate. In fact, I think I actually read that just before I got on the call on one of the newspapers. But the reality is, not all real estate is exactly the same. There's going to be markets that are going to definitely do better than others, even with all these inflationary times. In fact, that's why it's doing well, is because of inflation of maybe exterior markets, maybe pushing migration in or job growth here because it's more affordable and all these different things. But this is where, as investors, the more you dig into this, the more you get familiarized with this, it makes you a better investor. And for those that have been in this for a long time, Jennifer, you've been in this for 20 years, so have I. And I can't comment on yourself, but I have ridden this cycle, the roller coaster ride, a few times over. Been there, done this. I know this might be a little bit different, but at the end of the day, you tend to you learn how to manage and pivot these things, and paying close attention to some of the fundamentals. Again, it makes you a much better investor. It can be scary. I get it, been there, but it doesn't mean all real estate markets are bad. And in a lot of cases, these could be fantastic opportunities for a lot of different markets, right? So
100%. And I love that. And you mentioned earlier about types, real estate types. So like condos versus single family versus multifamily.
right.
And we haven't even scratched the surface on the asset types, in terms of whether it's like industrial or commercial or all of those kinds of aspects too, because there are opportunities.
Agreed. So kind of one of my last questions I have for you, and I always like to ask this of our guests, and you obviously got a lot of experience, which is always wonderful and helpful. But for a lot of the individuals that are watching live, and more importantly, and watching live and also watching the recording, this may be their first rodeo. They're looking to buy properties. Like, boy, did I get my training at the wrong time, because look at what's going on with interest rates and stuff. What advice would you give investors? And it's not just newbie investors, and it may be even people that are relatively new. This is a new thing for them. What advice would you give them that are maybe just getting started? And how should they best manage through this thing? What advice would you give them? And I ask you to maybe put your real estate investor hat on and sharing some of your wisdom of 20 years of experience.
Great question. I'd say, first of all, keep your day job, because you need that to qualify. And that is, don't try to become a real estate investor full time. Keep your income so you can purchase and acquire properties. And then I would, because we are coming into a softening, it may feel like a great idea to wait to purchase and to acquire. Maybe even sell right now. Like, it's a possibility, and I can understand and appreciate that. You have to do your own finances, your own financial bandwidth to be able to weather this softening, this, if you want to call it even weathering a storm, for the long haul. And I would also say, if you are doing fix and flips right now, please be careful. That is definitely an area that, unless you're super professional and you know exactly all your budgets and whatnot, just be mindful, especially if you're brand new starting out, because the market is softening. So that's just, there you go, fix and flips, be careful. But for the long-term buy and hold, there is potential for a decade of an uprun. And then what we don't know, and many of us haven't experienced this before, so that's why I'm researching it and interviewing qualified individuals from the 70s who have been through this before, is that there may be an offset and hear me out, and I'm modeling this, and I am going to be presenting it at my next research lab on July 27th, is that there is something there where, although it might feel like you want to wait to buy or to acquire because interest rates and inflation and the softening, there may be a benefit, maybe a benefit of buying now, getting an earlier interest rate, riding the inflation, and paying down that mortgage as inflationary times occur. But you have to be able to have, again, the mindset, the confidence, the network. I love that. The community, like you have at Savvy Investor, like we have the Real Estate Wealth Lab, to really help support that mindset and mind frame to go through this.
Awesome.
And to stay on top of it, because it can change with one announcement.
Yeah, I agree. And like I said, one of the questions I don't think we got to is just how quickly these things can turn around, or how quickly these things can change, right? We talk about the stock market, it can change in a day. It maybe not be that quick, but it can change pretty quickly, right? So
here's the thing. It can change fast, but it actually takes more time for it to work itself out in the real estate market. Basically, you've got a year or 2 years. Typically, there's an announcement,
right.
And then the real estate market is slower to respond. So it's much more forgiving. Whereas a stock market, for example, it's here's the announcement, crash burn or whatever, and then it goes up, etc. Whereas real estate, okay, XYZ announcement, let's say that impacts GDP, then okay, fine, then we've got 2 years, all things being equal, you can kind of at least have some time to talk through it with your friends or with
right.
your, mentors or your mentee, all these things, and kind of make a more strategic plan rather than being super reactive. You can be responsive. So
love it. Love it. Great information, valuable information. I hope you guys all paid attention and listened. But again, this is such an important topic for all, especially right now. Jennifer, you referenced a little bit about Real Estate Wealth Lab. If people want to learn more about this or learn more about you and your company, what can they do? Where can they find you?
I love it. So thank you for that. And I thank you for the opportunity, Michael. And I'll be sharing, I guess, first of all, at Savvy Investors, what is it, on the 18th, a little bit more
that's
about
that's in our mastermind group. So for those that are part of our mastermind group, you're going to get right into depth with it. So you get really Jennifer, and we'll go into a little bit more of the nuances of stuff, right? But yes,
for sure. And then, so thank you. The Real Estate Wealth Lab, we host 3 events a month: a Market Leaders Lab, a Community Lab, and a Research Lab, as well as we've got calculators and a property shop, and you name it, and including a research newsletter. It's a real estate intelligence newsletter report that is produced weekly that takes all those scariest headlines that are going on out there and the news and the studies and unpacks it for real estate investors in is this an avoid, sell, buy, hold kind of scenario, and really shares like what's happening on a regular basis. So I'd really encourage individuals to come out. We have a free trial, and I'd love for individuals to come out, check us out. Thank you. Oh, you popped it on the screen. So yourrule.com/trial. We're really new. We just launched in January, although all of the folks who are involved have been investing in real estate for decades and decades. And we just realized that there was a real niche in the real estate market for unbiased research by real estate investors, and to get those calculators up there. So we'd love to see you. It's a great community and provides a lot of value.
Love it, guys. So you know what I'll do is, for those that are watching the recording as well, is I'll post this on our YouTube channel in the description. So for those that maybe have missed the live training session, I'll just post it there. So if you just want to learn more, or take advantage of Jennifer's beautiful offer in regards to listening about some of the things that are going on. Like I said, this has been an interesting ride for the last 4 to 5, 6 months. It's been a topic that we've shared a little bit on YouTube quite a bit. But again, this is something as investors, we do need to stay on top of and be aware of. So thank you for this, Jennifer. And again, thank you so much for being part of this. I can't thank you enough. Taking you away from your wonderful Hawaii living environment, your why, and coming and sharing some of your awesome knowledge with our group. So thank you very much.
Well, it's absolutely my pleasure and my passion to support real estate investors with research. So yeah, and I think I didn't mention this, so it's July 27th is the next one.
Wonderful. Perfect. Good.
Thanks so much,
so guys,
Michael.
Thank you, Jennifer. So as we kind of conclude, again, thank you guys for joining us today live. And I hope you found a lot of value with the presentation as much as I did, because I learned a lot of interesting things myself, and I love talking about this topic. It's such a fun topic. So as we kind of wrap things up, I'm just letting everybody know we've got something else that's going to be very exciting as well that just got posted on YouTube and also on our Savvy Investor page. We will be hosting a brand spanking new investor series on the topic raising capital. So for those of you that are actually looking for money, anybody else looking for money, or is it just me? Because for those that like money, we'll be doing a four session series talking, teaching all about how to raise money for your real estate investing projects. Here's the best part. It costs you nothing. It's absolutely free. And it's going to start this Saturday at 4 p.m. Pacific Standard Time. Then it'll be Monday, Tuesday, Wednesday. Very informative series, which we hope we will see you guys there. So again, check it out. It's on our Facebook page. You will be the first ones that are watching live. You'll see this on our YouTube channel. But hopefully you guys are able to join us. Again, thanks again for joining, everybody. And with that being said, if you haven't already, do me a small little favor. Hit that subscribe button if you haven't. Again, we are trying to grow our YouTube channel, so always appreciate your guys' continuous support as you always have. Again, thanks, everybody. Have a wonderful evening, and I look forward to seeing you at our next investor series. Thanks.